Hey everybody, this is Coach D with TackleTrading.com. Just wanted to walk you through just a quick adjustment on a bear call spread that is at a little bit of risk. And so, the trade hasn't gone horribly wrong yet, but it's not working out as much as we'd hoped. And I'm talking about this trade here on Tesla. So what I have here is Tesla, okay? And this is a bear call spread. It's a 360 by 365 bear call spread. Expires in 16 days. And we got 5 by 5 contracts right there. So you can see, the general scenario. And it's drawn down a little bit. It's down $79 or so. Nothing too bad. It's tying up $2,500 in margin. And this is just a classic bear call spread. Let me go ahead and kind of walk you through what we see on the chart, which is what's kind of led me to concern. So again, this is a bear call spread. We sold the 360 call, bought the 365. So those are the two strike prices out there. And it's put in a double bottom here. Double bottom where you can see the W pattern right there. And it's broken out and it's moved to a new high. Now with that, currently, with the way it's sitting right now, what I'd anticipate is it looks like it's kind of in a support resistance zone. I might anticipate a small drop back, but then it looks like it's reversing back up. And so it's, the strikes aren't too far away, but we can start adjusting the trade right now just to help improve, the potential situation that we have on this. So let me just go ahead and take a look at the risk graph with you here. And here's what we see on the risk graph. Is again, we can see these are the strike prices, 360 right here, 360, and then 365 is the other strike price. And this is again a bear call spread with the net credit between the two. You can actually see that pricing down here. Let me zoom that out so you can see that here. Okay, so you can see where we brought in $1.57 and spent $1.20 on that, and so that gives us a maximum profit of $185. And that's, price could continue to rise. And my general concern is right here with the delta. At the current price, this is where the current price is trading at 340. The current delta at 340-ish, 339-ish, is here at -20. And this has risk to the upside. If the stock price continues to rise, you can see where anything above that 360 price puts us in trouble, and it continues to draw down a little bit. Once you get past that strike price and you get past that theta switch point right there, those are the price points where you start losing more and more money, and you can see where you could draw down. You could very, very quickly be at $1,000 loss or more. You could lose up to about $2,300 on this trade total if you let it blow out the top and you didn't do anything. And I wanted to walk you through this simple concept on the adjustment on this is just as follows. We can actually start the adjustment right now by turning this into a condor. And so what I can do here is I can go add on a bull put spread, an equal $5 spread, and we can bring in a 50-cent credit. And although this doesn't necessarily eliminate the risk, of course, what it does do is it increases our potential return. It reduces our risk to the extent that we get the credit, and it'll neutralize the delta, which means it'll take less money to hedge if we need to. So right now that delta, again, here's kind of what I want you to pay attention to, is watch this delta column right here. Watch this number right there. And what's going to happen here is the max credit's going to go up by 50 cents times 5 contracts. And then the risk profile is going to go up by the same amount. And it's going to end up looking like a risk graph that looks a little bit like this, a little bit higher here, a little bit more profit, a little bit less risk, and a little bit more neutral delta. So that's what we're going to see. So let me go ahead and check that box down there. And I chose a 315 by 310 strike price based off of my delta rules. Just wanted to put on a typical spread so that I didn't overexpose ourselves to risk if it ran down. And so that's exactly what we see here. We see that now the position, the maximum gains $435, reduced the risk to just over $2,000. And most importantly, what we did here is you'll notice now that delta we've neutralized down to just 2. And so what that means is if the stock price continues to run, we could just add on a long call, we could buy some stock shares, or we could do some, change the trade in a way so that we could hedge it out if the stock price continues to rise. And we start out by turning it into the Condor, and that neutralizes us so that we don't need to throw nearly as much money at it to offset the risk with the hedge. And we could easily, start hedging that out. Let me squeeze that up so we can see that there. Just by buying a long call, and I've got an example of buying a longer-term long call here out in January with just enough delta to offset the risk. And so if it continues to rise, throw a little bit of money at the issue, and if it continues to rise, we can eliminate that risk altogether so that because if it continues to rise, we don't ever have to let this winning trade, what will be a winning trade, turn into a losing trade. So, step 1, put on the put spread, changing the bear call spread into a Condor, neutralizing the delta. And then if it does continue to rise, we have less risk to begin with. We can continue to roll the puts up if we want to, but we can also have the ability to simply buy a call option or buy some stock shares just to offset the risk. And by lowering that delta number, we lower the amount of capital it takes to throw on that hedge. Again, Coach D with TacticalTrading.com. I hope you enjoyed this video.